Hey guys, welcome back to 90 Seconds with Chris. In today's video, we're going to talk about an initial public offering, commonly known as an IPO. What is an IPO? An IPO is simply the process in which a private company goes public by selling its shares to public investors like you and me. So there are two basic reasons a company could get an IPO. First, which is also the least common method, also known as a direct IPO, is when a company goes public so that some of its existing private investors or employees can cash out their shares in the company for money. In this method, typically the company has no aim of making profit through the IPO, so no new shares are created because the company isn't trying to raise some money. The second reason, which is also the more common one, is commonly called just an IPO, is when a company goes public to raise money for expansion or to work on a specific project. In this method, a bank is brought in to value the company, and based on the value of the company and the share price, additional shares are created so this company can raise as much money as it needs to. Back to the bakery example, I needed $10,000 for startup, but I only had $2,000. So I had to raise $8,000 difference by selling shares to 8 investors at $1,000 per share. In this scenario, I own 20% of the business while each of my other 8 investors own 10%. Fast forward 10 years, we're doing so good, we're now worth $10 million, and we decide to IPO through a direct listing. So each of my investors can cash out for money. At this point, each of the 10 shares in this company is now worth $1 million as opposed to the $1,000 it was worth when we started 10 years ago. Now each investor can decide to cash out for a future investor.